insurance. We've known each other for quite a few years. You've done a bunch of deals, helped out a lot of clients. So I really appreciate it. And I'm glad you're coming on here to share your insights on insurance. So if you don't mind giving a quick introduction to our audience about your background and your company.
Well, thank you, Joe. It's been a pleasure working with you and helping your client. We're there to support the real estate investors in Florida. My background, I started with AIG right out of college, which it used to be the largest insurance group in the world, with operations all over the world. I was in London, in New York, then in Latin America, in Chile and Ecuador, where my wife is from. So I've been involved in the reinsurance side in London, everything that ends up causing the technical and rate changes that we experience here in Florida have to do with the worldwide insurance market. It's all interconnected. So I think I bring that perspective to the insurance business more than maybe a lot of people who have only worked in Florida.
Okay, no, that's I had no idea your international background. I had no idea. That's really exciting.
I spent more
than
than
a whole
20 years
whole
overseas.
universe of insurance.
Yeah, I spent more than 20 years overseas running property casualty and life and health insurance in different countries, insuring earthquakes in South America, oil refineries in the Middle East, shipping around the world, and all that goes back to the same big reinsurance markets in London and New York, where people put up the capital to pay for the big claims, and that is the one we depend on here in Florida for the reinsurance support. To give you an idea, I looked up the statistics. The Florida commercial insurance market total for a year is $30 billion. And just Hurricane Irma is now $15 billion in losses. It started out being an estimate of $9 billion, and it's now grown to $15 billion for a lot of reasons we can discuss in this interview. But that's half of all the premiums. That includes auto insurance, liability insurance, all kinds of commercial insurance. Just one hurricane wiped out half of that. So there's no way that local insurance companies here in Florida or even in the United States can pay for all of that without the support of the worldwide reinsurance market.
Wow.
So the reinsurance market says that they're losing money because there were tsunamis in Japan and fires in California and earthquakes in Mexico and floods in Europe. They're paying for all of that. There's a limited amount of capital. The investors want a yield. The interest rates worldwide are collapsing. They're saying, why should I risk my money in something where I can lose my shirt? I'll invest in government bonds or something else for a while. I'll pull back, wait until the storm season ends, and then there's a lack of capacity. So we get into the situation where people want us to quote alternatives, but we can't even get a quote because once a quote is on paper and it's firm for 30 days, they have to respect that. If I go back 29 days from now and say, I want this building covered, they have to respect that. So they set aside that capacity, that $1 million, $2 million, $10 million of capacity for that quote, and they can't release it until 30 days from now to insure something else. So it's not just what you can insure, it's what you can quote and get the pricing at any given time. It becomes very difficult, especially this time of the year in the storm season, because of the windstorm risk.
Interesting. That's okay. Do you mind giving a quick, so our investors almost all are multifamily owners in Central Florida, and your most typical insurances, you've got, general property insurance, you've got liability insurance, and you've got some business replacement insurance. Do you mind giving a quick rundown on those and what someone should look at when they're shopping for insurance?
Sure. For multifamily property, you're going to need general liability for the premises, slip and fall, accidents with contractors, anything that happens on the premises, or lawsuits by your tenants. There are a lot of frivolous lawsuits now with assault and battery claims, inadequate security by the landlord, even on properties that don't have gated security or monitoring. Then you have the whole issue of property loss from fire, water leaks, roof leaks, hurricane damage, anything that's direct damage, that's called the property coverage. Thirdly, if you're in a flood zone, you will need flood insurance, which is separate from property insurance, usually a better price with the federal program. And if you're doing your financing, any lender is going to require that you have flood insurance. Those are the three major types of coverage you need to be concerned about. If you're then doing an agency loan after you've owned the property for a while, there will be additional requirements such as excess liability, higher liability limits, $2 million, $3 million instead of $1 million. They want to see that coverage. They'll want to see clauses like terrorism. They'll want to see coverage like law and ordinance, and the coinsurance values. Those are two very important concepts that the more sophisticated the lender, the more demanding, the more you need to get into the details with these policies.
And I guess that's typically dictated by the lender, the type of insurance that's required. Is that correct?
Exactly. You get a schedule, you get a list of the requirements. We help the client. We quote the policies with those requirements. It's generally going to be about 20% more expensive than without those requirements. But you're going to be you're going to have much better coverage. For example, you have a building from the 1960s built under very old building codes, and there's a fire in one unit, and half of the roof is damaged, half of the building is affected. That municipality may not let you build or repair that building the same way, just those units. They'll say that the whole building has to be brought up to code, or you may even have to demolish the whole building and it's cheaper probably to build something newer, right? But if only half of the building was affected by the fire, the insurance is only going to pay for the affected part. The law and ordinance coverage at 100% says, if you're required by law or ordinance to demolish this and replace the entire building, we will pay to rebuild the entire building. So it's one of the little things in the fine print that sometimes if you go for the cheapest policy that's not in there, with an old building, frame buildings can have a lot of fire damage. These are important things to take care of. The other thing is coinsurance. If you see 80% coinsurance on an insurance quote, that means that the value that you're insuring has to represent at least 80% of the replacement cost of the building. Who establishes the replacement cost? The insurance company is going to get different appraisers. There may be, some subjectivity in that, but more or less, a property owner should know how much it costs to replace the building. Because if you only insure, let's say, $500,000 on a building that costs $1 million to reconstruct, and you have a $100,000 fire loss, they're only going to pay you $50,000 for that loss, because you're only paying premium for half of what you should be insuring. Now, the insurance companies are mostly just concerned with collecting enough premium. They're not thinking that the whole building is going to be destroyed. So we work with companies that will waive that condition and not apply coinsurance, as long as they see that the value per square foot is set high enough. So that's what we always look for. It's called waived coinsurance or agreed value, and it's a very important benefit for our clients.
That's interesting. And for your company, how you work, you're an agent, correct? So you shop it out to multiple different actual insurers.
Exactly. There's a whole distribution channel system in insurance. We go to wholesale brokers, and those wholesale brokers will work with 20 different companies, and we'll usually go to 2 brokers to cover all the bases. So they'll each go to 20, and maybe 10 of those are in common. So you're going to go to 30 sources maybe, and to get of all of those, we're going to present the best alternative, the combination of price, limits, coverage, quality. We haven't touched on that yet, but the rating, quality rating of the companies in insurance, it's usually the AM Best rating, Credit Ratings, which is a company that just does insurance companies. You can also have big multinationals that are rated by Fitch and Moody's and are listed on the stock exchange, but Generally, the insurance requirements by lenders are an AM Best A-rated company. So that means these companies have to go through audits and submit their financials every year to see that they're in good financial shape, and that gives us the confidence to work with those and recommend those to our clients.
When it comes to that kind of, what have you seen people make mistakes on?
I see people make mistakes in insuring too low a value, and then they'll have a co-insurance clause on the policy. They'll have a minor claim, and they'll be shocked that the insurance company is not going to pay the entire claim because the insurance was not brought up to value. If you bought a building 5 years ago, obviously the reconstruction cost today is much higher. So you have to keep up with the values, maybe a small inflation adjustment every year on your policy. Obviously that's going to increase the premiums, and a lot of people don't like that. But that's probably the key issue is the insurance to value and the limitations on the policy. In order to make policies cheaper, a lot of companies are simply excluding water damage. Water damage means water that comes out of the wall, out of a pipe in the building. That doesn't mean flood or water that comes in through a hurricane. The water damage has a very specific meaning, especially in Florida in insurance contracts. So if you exclude that, you exclude all of the consequences like the drywall that you have to rip out, and you're also excluding all the possibilities of fraud with assignment of benefits and plumbers that has been rampant in the state. So insurers really want to limit that or exclude it entirely. They're willing to give you a much lower price. Unfortunately, a lot of the companies that do that are also the lower quality companies. So I would be cautious with companies that want to exclude it entirely. Unless it's a very old building and it's never had the plumbing redone, there's no reason why it should be excluded. We would not recommend a policy that has that exclusion.
Speaking of old buildings, this for me is a funny one because in my universe, a new building is built in probably the early 80s. That
Right.
is a new building for my universe. Other people considered it not quite as new.
Right.
So we end up with a lot of interesting scenarios, both as far as, FPE panels, Zinco electric panels.
Right.
We end up with also plumbing that varies the spectrum of everything you can think of.
Exactly.
Roof ages also vary significantly. When
Right.
someone's purchasing a new property, what process or what should they be looking for each of those, the electric panels, the roof, the plumbing?
Right.
What else should they be looking for when they're going to get a new insurance quote?
Right. If you have a multifamily building with a roof that's flat membrane and it's over 20 years old, it's going to be difficult to insure. If it's if it's concrete, tile, or metal, or some other, it can be older, maybe 30 years. But once you get over those thresholds, then the insurance companies are going to be pickier and they're going to prefer to insure other things, or they're going to give you a very high price. Once buildings get past the 40-year certification mark and they see that there hasn't been a refit of the electrical panels, there's still some of the stab lock panels there, they'll deny the quote, or they'll even cancel policies that have been issued once they're inspected and they find those panels. Now, plumbing doesn't mean you need to rip the whole building apart and change all the plumbing. It just means that you need to change the water heaters, you need to change the fixtures, you need to show that there's been some regular maintenance or updating to the building and everything's not just stuck in time from 1960. The other things that are not directly the building, but the rental policies like pets, pets are considered to deteriorate the property, things that, poor air conditioning systems can create mold and mildew, inside the drywall. So these are all the things that they look for. So they want to know that something's been updated within the past 20 to 25 years you're good. But have that documented, have an inspection report, receipts from the roofing company, a roof certification, and that's going to make the biggest impact on getting a good price. Because right now, they'll charge you $10,000 if it's a updated building, and if it's not, they'll say, well, $20,000, take it or leave it. It's not like it's going to be 10% more because you have 10% less updates. It's not proportional.
So for roofing, I mean, you've got the spectrum of metal roofs, shingle roofs, membranes, flat. Like, do they look for certain years that you have to have had it replaced by, or is it? I mean, what are the
ask for a condition report, and as long as the inspector says it is in good condition, and there's a building permit somewhere they can find that it's been done in the past 20 years. If it's flat, you're okay still in Central Florida. In South Florida, they're down to 10 years. Anything over 10 years, a flat roof is getting very hard to insure. The further you are inland, the less that is going to be a factor. But in frame buildings with shingle roofs, maybe 15 to 20 years, and the concrete tile and metal are going to be the best roof. It could be 30, 35 years, still be in very good shape.
So if you're purchasing a property, do you need to plan on putting a new roof on, or do you need to have the roofer inspect it, or what do you do to make sure that you're not going to get a surprise, 4 months after you buy the building and the insurance inspection comes by?
The best thing you can do is pay for a 4-point and wind mitigation inspection. Depending on the size of the building, it could run between $200 and $500, let's say, to get a good inspection done with photographs, permit searches. They'll certify when the last roof permit was approved on the building. They'll go up and check for any cracks, any deterioration on the roof. And if you're within the guidelines, then you're going to be fine. You can't have a surprise because the other inspector goes out, he's going to find exactly the same thing. The worst thing that can happen is to buy something and then have the insurance company send their own inspector 60 days later, and then, sorry, you have Challenger panels from 1960. These are a fire hazard. You either change it or we're canceling the policy. That's happening a lot. They're getting more and more picky and inspecting more and more properties. So look at the electrical panels, the electrical system. See there's no cloth wiring in old buildings. Check the condition of the roof. Have an inspector get up there. Look at the plumbing system, the water heaters, and all the fixtures, and take that in when you're going to buy the property, and make a plan or a provision for gradually updating these things if they're reaching the end of their useful life.
The electric panels, is there anything to really look at besides the breaker boxes with the old stab locks? Is there anything else you really need to be paying attention to?
Well, there are some buildings that still have fuses, right? The fuses are okay if it's just the service disconnect. Like sometimes I'll have a little box with 2 fuses and a handle. So if the power company needs to do anything or an electrician needs to do something in your building, they just cut it off there, and then everything else is handled by the breaker panel. But the building should have circuit breakers, installed after the 1980s. You're generally not going to have the fire risk of the old panels that were considered a hazard. Challenger, Stab Lock, Federal Pacific, there were a few brands that were higher risk.
When you're looking at the plumbing, like some of the buildings may have, copper plumbing built in the 70s or 60s. Some may even have been replaced, but they replaced it during the time when we had polybutylene. What should you be looking at the plumbing?
Well, if the plumbing is, there's a crawl space, then it's relatively easy to get a look at the plumbing and change it. If it's in the slab, and the inspector thinks that it's that it's cast iron, plumbing, and there's nothing you can do about it. The insurance company is probably not going to look at it too close, and sometimes those pipes really don't give you as much trouble because they've been inside the concrete for so long. If you're close to the ocean, then you have the salinity and the rust problem. It's probably worse there with the embedded pipes in the concrete.
They're looking at getting quotes from an agent, how do you recommend that an investor first of all, work with an agent? And the second would be, how do they shop different agents, or what's the correct process from your perspective for an investor to use when they're shopping around for insurance?
Right. Well, it's natural to want to get different opinions and different alternatives, right? But more and more in Florida, there's a limited market for commercial insurance, especially with windstorm coverage. So it's all going to come back to a certain number of carriers that operate here. So it doesn't really serve the client very well to go to 5 different agents, because those agents are then going to be contacting the same 4 or 5 big wholesalers, and then they're going to get blocked, and one wholesaler is going to say, well, I already gave this quote to this other agent. So if one agent is able to cover the whole market and then do a comparison and then present it to the client and hopefully sit with the client and look at all the details so the client can make an informed decision, that's always the best way. That's what we try to do. We're not out there trying to steal business by getting a cheaper quote. We're trying to serve our clients year to year, and we get new business by referrals, but we're not trying to undercut just with price, because like I say, some of these details, the devil is hidden in there in these details, and one quote that can look a lot cheaper can really leave you out to dry. For example, if some people assume they can do short-term rentals with some of these properties, but if that's not accepted specifically in the policy and the liability isn't rated as a hotel exposure, or if there's a fire, that claim can be denied completely, and you won't have any defense in a lawsuit. It's a simple example. Dangerous breeds of pets. If you don't have the right coverage, dangerous breeds are always excluded, but you can cover certain dog breeds if you have a lawsuit on the property, but that has to be included. Sometimes you'll pay a little bit more, sometimes you won't, but it has to be covered specifically. So I would recommend that clients try to find somebody they're comfortable with, and make sure that agency has gone to enough markets so they can make an intelligent decision and give you the best alternatives.
If they're shopping for an agent, what's something that because there's obviously, I don't know how many insurance agents you can get insurance from, but there's tons.
Right.
How would you go about selecting or what questions to ask, or what would distinguish one agent from another? What would you look for?
I would start by asking if they work with carriers that are AM Best rated, or if they tend to work with Citizens, let's say, Florida, or Florida domestic companies that are not AM Best rated. Those policies will have weaknesses. They'll be insuring actual cash value instead of replacement costs. They'll have water exclusions. They'll have all these limitations. So you try to compare apples to apples. And, that would be one simple way of filtering. And then it would be to ask, how much of your business as an agency is commercial business? If it's somebody who basically does personal lines, insures cars, and people from time to time they insure a building, they're not going to have the expertise, and they can make a very big mistake if they don't know what they're doing in commercial business. So look for an agency that works with highly rated companies and does mostly or half of its business in commercial lines and has years of experience.
Okay. insurance, when you're going about renewing the insurance every year as it's coming around, what is your recommend? It seems like it goes up every year. I mean, most of the time. We went through a little spell back in the early, let's see, probably 7, 8 years ago, where it actually went down. But it seems like of late, it's just gone up every year. What is your recommendation for what to do when your premium comes for the annual renewal?
Unfortunately, like I said at the beginning, we're subject to the worldwide reinsurance market, a shortage of capacity, and that's just supply and demand. So the prices are pushed up. And there's no such thing as loyalty in commercial insurance in the way that you have if you're insured with State Farm or something for your house and car. They'll keep renewing you for 20 years and they won't increase your premium too much, usually. They try to retain you. Whereas in commercial insurance, we pretty much have to quote everything all over again every year because there's so many companies that are coming and going, leaving the market and can't keep insuring. So the most important thing is to check that the quote that you're getting for the renewal covers the same thing that you were getting covered the previous year. And it's not excluding things, hurricane, water damage, assault and battery, or any of these things that are reduced in order to make the policy a little bit cheaper, and then make a decision about how important those things are to you, or whether your lender is going to require an increase in the sum insured, or if you want to keep it at the same value and stay within the 80% so you don't have to pay too much more that year.
For flood insurance, is there something else other to check besides the FEMA flood map and look for the X zone versus AE? Is there anything else to check on a flood when it comes to flood insurance that the buyer needs to know?
Well, flood can be very complex. If you own a controlling interest, let's say in a condo complex, and you own more than half of the units, then you're on the board, you're controlling the board, you're making the decisions. And condo associations are obliged by the condo law in Florida to have full flood insurance, including the interior alterations. If you own a duplex, a quadplex, and you're not in a condo association, then you have to get your own insurance. But if you don't own the whole building, maybe the owner of the other side has a different philosophy and they don't want to insure the whole building. You're going to have to insure just the unit. So it's a different type of policy that you have to insure. There are private insurance companies now, a lot of options for private insurance in flood that will use geocoding, like just map coding from a different provider. They don't run off the FEMA maps. They have their own systems to analyze whether something's high risk or low risk. So sometimes we get a much lower premium with a private insurer for a house on the water or a building right by the beach than with FEMA. Sometimes it's the other way around. Sometimes the private insurer won't want to insure it, and then FEMA is your only alternative. And if you're in a barrier island or a repetitive flood zone, that's getting more expensive. But the most important thing is to have the elevation certificate, the survey done when you're buying the property, check the elevation. Even if you're in a high risk zone, that property may be elevated, might have a crawl space. You might not have a high flood premium. It's just getting all the information, giving it to the agent, and let us run all the analysis.
For the universe of windstorm insurance, what are the rules for that? I mean, I remember it used to be, it was basically east of 95. You had to have it, and west you were pretty much didn't. Has that changed, or what are the rules today?
That's the wind pool, the wind pool area where Citizens is obliged to insure you if you can't find another alternative. And the banks, lenders generally use the same rule of thumb to require insurance, but now we're seeing that they're requiring windstorm coverage even well inland. And we're also seeing that because of overdevelopment, they paved over so many areas that used to be farmland or marsh that you're getting severe floods in areas just because the water can't drain anywhere. It may be higher land, but the water just can't go anywhere fast enough, and it's going to end up inside your building or inside your warehouse. So that's something to keep in mind. You could be in an X zone, but you're still very exposed to flood. And because you're in an X zone, insurance is going to be very cheap. It's only going to be about $1,000. But you could lose $1 million if you have to rip the whole building apart if you get 6 inches of water inside the multifamily building.
That's interesting. For the universe of liability, sometimes some of these apartment buildings, there's criminal activity, there's varying things, disputes, a lot of interesting things can happen in an apartment building.
Exactly.
What is your experience for the best practices for an owner for someone who's operating an apartment building to do to make sure that they have done everything they could do to make the property as safe or as possible?
Yeah. Well, take all the precautions, filter the tenants before you sign a lease. Put all of the covenants as an addendum to the lease. Make sure the building covenants are very strict about dangerous animals, about firearms, about raucous behavior, time limits for parties. All of these things. Post signs everywhere about the rules. Post signs about entrance and exits, fire hazards. Make sure all of your fire extinguishers are recharged and certified every year. Make sure you put slip and fall notices in areas where it's constantly getting wet. Put the non-slip, paint on the hallways. Anything that's exposed to water. Just be as obvious as you can. That's going to protect you in a lawsuit, definitely, because there are a lot of frivolous lawsuits being drummed up now, and that's affecting the landlords. Are defended by the insurance company, but ends up pushing up the price of insurance.
Do cameras, additional lighting, alarms, do those help you in that front?
Sure. If the landlord is somehow responsible for the security on the premises and is going to be monitoring it, yes. But you also have to be careful. You have cameras on there, nobody's watching the cameras, then you're negligent for not watching the camera. So, or not having it in the right place. So that can be, a double-edged sword. The most, take as many security precautions as you can. But I'd say, fair warning to the tenants and the rules in the building and the signage are very important.
We were talking about dangerous breeds for animals. One of the issues that's coming up with apartment buildings is the emotional support animals. And now there's a conflict between insurance saying this type of animal, this dog, is not allowed versus it is legally, you have to provide fair housing for someone with an emotional support animal. Have you worked through that, or what have you seen?
We haven't had a case like that specifically, but I would encourage the landlord to get information from the city on the ordinances. I mean, I can't believe that somebody could have a dangerous emotional support animal, allowed within. There must be some way of limiting that without having a problem.
You would be surprised. That actually it's like a whole lot of them were Dobermans and also pit bulls and and they had the paperwork, emotional support.
Right.
So anyway, it was a
whole universe
of excitement for a landlord.
Well, of course, I mean, the landlord has no control over the person's dog. The landlord can control whether they rent to that person or allow the dog on the property or not. So it's all about proving negligence. So if it's allowed and you can't prohibit it, then you have to establish some other kind of rule about, okay, this dog can be here, but it has to walk down this hallway at these times, you know, and it cannot other tenant, you know, and Lord is making a concerted effort, you know, to do the best he can to, you know, all of the tenants in general, then.
Do you mind giving a 5,000-foot view of how the insurance business works? Because I assume it starts with, like, you have the insurance companies to a property, then that insurance company has some reinsurance behind them, and in between those you have obviously an agent talking to the actual investor of the property. Then I guess you have brokers who are wholesale brokers. Do you mind just walking through
Sure.
that process or how it's set up?
Yeah, a client or a real estate investor will come to a retail agency, a primary insurance agency like us, and give us the information. We'll collect all the information, and then insurance carrier in Florida, it's common to work through wholesalers who have access to companies that are not in Florida, or managing or wholesalers. And those wholesalers often have the authority to issue the policies, to quote and insurance companies that are in New York or California or England, or they have to send their paperwork, those companies. So it's another submission that makes everything until somebody in New York, Chicago, Atlanta, whatever, makes a decision and then approves a quote. And then once that quote is approved, we present to the client. The client agrees to the pricing, the conditions, and we order the issuance. And then the paperwork has to be signed by the client, goes back to the wholesaler. The wholesaler asks for the policy from the insurer. Now, behind the insurer is insuring 10,000 buildings in Florida. It cannot pay for a hurricane loss that could affect half of the state, and 5,000 buildings are affected. So it takes out insurance for the insurance company, which is called reinsurance. So that distributes the risk. So of the 10,000 houses, you know, 1,000 are placed with a company in Japan, 1,000 with a company in London, 1,000 in New York, 1,000 in Chicago, with a whole big market, worldwide reinsurance market, where each company tries to diversify. So a company in the United States wants to insure some things in Florida, some in California, Texas, New York, Michigan, etc. And then they take out reinsurance, and the reinsurer in London wants to insure things in the US, Japan, California, specifically for earthquake, Africa, wherever. They don't want all their eggs in one basket. So that when Hurricane Irma or Michael come through, they're not the only people holding the bag, and they are not covering all the houses or the buildings in that area. That's the distribution of risk. It's a basic concept of insurance, which started out, you know, with the camel trains, people going to India to buy silk, right? And, you know, they'd all get together, you know, 500 camels, you know, 100 merchants, and they'd say, well, we're all going to hire all these soldiers to protect us. And if we, you know, get attacked and we get killed or robbed, or there's a storm or whatever, and we lose 5 of the, you know, 500 camels, we're all going to share in that loss equally, right? So that's the most primitive, you know, concept of insurance. And then you have Lloyd's, which was a coffee house in London, where people started doing the same thing for shipping, right? They were sending a ship to Hong Kong or something with, well, you know, industrial products from England, and they weren't going to get paid until the products got to Hong Kong. If the ship got sunk, they would lose everything. So all the people putting stuff on that ship said, well, let's get together and share this risk. So if there's a storm and some of the stuff goes overboard, you know, and it just happens to be Joe's stuff, well, Luis and John and Mike, and we're all going to help pay for Joe's stuff. So that's how Lloyd's started with marine cargo. And if the ship sinks and the investors in the ship, they all get together and they all get their money back. So it's all about sharing risk. And it's just gone on and grown into this big international market, which comes back to affect us in Florida specifically because of the hurricane risk.
How, and in the current market, how competitive is insurance in Florida right now? Is there a lot of insurers looking to do business here? Are they pulling back? What's the current landscape?
In multifamily, there are probably about 20 major companies that have been very active, and maybe 5 of those have withdrawn or reduced their activity this year. In homeowners insurance, there's something like 50 companies, and 10 have folded or had to merge. Others have left from other parts of the U.S., have restricted and started writing less or pulled out entirely. So from there, you've gone down from 60 maybe down to 45. So that has a direct effect on the pricing. And then you have a lot of things ending up with Citizens Insurance, which people should be aware is not really an insurance company. It's a state fund with the law that created it that allows the state to lend money to that fund so people can get their houses rebuilt, but then the state wants its money back. So Citizens has to return the money to the state, and Citizens is allowed to tax all of its policyholders for several years after a big loss to recover that loss. So if you're with Citizens, you may get your loss paid right now, but then you're going to pay for those losses through assessments for many years. The people who were with Citizens back in 2005, and the big hurricanes just stopped, paying their assessments maybe 5-6 years ago. So there's a big problem there in the capacity and the number of companies and who can write all of this business.
For an actual execution, when it's particularly in my universe where we deal with a buyer, they have the property under contract, they're going through due diligence, you're getting close to closing, and in order to close, obviously the lender wants to see the policy in effect. What kind of timing, or when should they start talking to their insurance agent, and then what are the steps they should do to make sure everything's ready so that they can close on time and satisfy the lender's requirements?
Right. As soon as you have an accepted offer through 100 units or through another broker, that's the time to start putting the insurance together. The important thing is to get all the inspections and the technical information as soon as possible. So if it takes time to get surveys, appraisals, maybe not wait for the bank appraisal to come through or the bank inspection to come through, but pay for an insurance inspection, a couple $100, and for an estimate from a contractor or anybody who can establish the replacement cost of that building. That gives us what we need to work with. We can speed everything up a couple of weeks because the bank is going to wait to do all these in the later stages of the deal. And then we end up getting an appraisal value that's completely different from what we quoted. We have to go back and redo everything, and the lender's pressuring for proof of insurance. But you need to know how much insurance is going to cost to see if you want to really go through with a deal, right? You want to know if there's any hidden damage in the building. You want to know if there are any problems with the lien, all the things that the real estate broker is going to help you with. So you need to know it in advance as far as possible.
How long does it typically take from a buyer contacting you saying, "Hey, I have this deal in contract. We need to close next week"? Is that something you can get done, or is that too short, or what kind of time frames do you need?
Yeah, we can insure something the same day. If we know that the roof was changed, if the roof was changed 3 years ago and the photos are obvious and you have the permit shows up on the county records and the building was built, 20 years ago, there's nothing to do, there's no problem with the plumbing or electricity, and we have a value to work with, we can insure that in 1 day. I mean, except for today, because today there's Tropical Storm Laura coming. We can't insure anything. We have to wait until next week, until it blows by. I hope it just goes out into the Gulf and doesn't affect us, right?
Me too. Yes, me too.
Right.
That's all. How long does it lock it? What's the rules about that when they lock out insurance? What is the parameters?
The insurers can do whatever they want. They don't really have to follow a rule, but as soon as the National Hurricane Center says that the cone is coming over Florida, that little map that they show, if it's touching Florida, they shut down Florida. They just don't want to take any risks. So, even if it's going, I mean, if it's out in the Gulf and they know it's only going to go up to the Panhandle, then they'll say, okay, from the middle of Florida up, and you can still write in South Florida if it's impossible for it to come back this way. But generally, they just play it safe. Anything with windstorm or flood coverage is blocked until that storm is no longer on Florida.
No, I forgot what I was going to ask. Well, I had some genius question too.
Yeah, so the best thing for clients to do is just get us as much information as soon as possible. They're looking at buying a property, and they're pretty sure they're going to go through with the deal. We can get a firm quote, but obviously, if they're looking at 10 different properties, we can't go out and quote all 10 because the markets we work with are going to say, hey, well, are these firm? Is this deal actually going through? Are we going to commit to this? There's too much capacity being committed here, but we need to know, that it's high probability this is going to go through.
I was going to ask you about mobile home parks. Have you worked in insurance on mobile home parks?
Yes, that's a difficult market for the windstorm coverage and for the liability aspects. There are carriers that specialize in that. If you're insuring just the operator's liability interest, or you own the land, or if you actually own some of the units, it gets a bit more complicated. It has to be a different type of policy, depending on how it's structured.
Do you have any rules of thumb right now as far as cost of insurance, say per unit or per square foot, that someone should use when they're just putting together a quick Excel pro forma for a property?
Yeah,
rather than wasting time actually getting a quote for it and coming back.
Yeah, we've seen that in Central Florida, we used to work with about $500, $500 per unit. That's creeping up. And the closer you are to the coast, towards towards Titusville or towards Tampa, then the rate is going to go higher. And if you're beachfront, then you're talking maybe $1,000 per unit, as long as the building is in in good condition, like I say. If a building is wood frame, it's always going to have a higher rate than a building that's masonry construction. To give you an idea, right now the rates in Tri-County in South Florida are about 1.3%, including windstorm, just on the property coverage of the values. If it's $1 million building, $13,000 just for the property coverage with windstorm. Whereas in North Florida, it can be 0.5%. And then Central Florida, somewhere in between. There's a huge difference depending on the concentration and how near you are to the coast.
So it's more dictated by the value of the building, or I guess the replacement value?
Yeah, it's directly related to the replacement value of the building. It has no relationship to the commercial value. So you could have a very big building in an area with higher crime and lower commercial value. It's still going to cost the same to rebuild that building as in another place. So obviously the insurance cost to value as a percentage of the yield to the investor is going to be higher. But usually the rates, the rentals are also compensating that a little bit. So you can get an acceptable yield on the investment. That's more your area of expertise.
I thought of my genius idea that I had forgot to ask. I get often asked when, as a buyer is looking through a bill, they want to get a new insurance policy. They ask for the old insurance policy from the seller, and then they also ask for a 3-year loss run.
Right.
What is why are they asking for what the seller's policy and what the seller did? What is the value of that, and how does that help?
The loss runs cannot be required of a new purchaser because he wasn't responsible for the property. But the loss run can help to show that even if the area is considered a certain type of area or risk, it really hasn't been a problem, right? So if there's a higher crime rate, but you can see that there have never been any accidents or liability issues in that area, it can help to negotiate a better price.
So the big value is helping the buyer negotiate with the new insurance provider.
Exactly.
And why do they want to see the current insurance from the seller, their policy? Does that help the buyer at all? Is there some advantage with that?
Yeah, insurers want to see that somebody else was insuring it before, and it wasn't something uninsurable, right? So if there was no insurance before, it's possible the building has some kind of damage or some kind of problem that's going to show up in the inspections, and it's not something you want to be insuring. Also, the loss runs will tell you if there's any litigation going on that property, and it can somehow be attached to the new investor if they're buying the company that owns the property. It should also always be a clear cut, right? It should always be a new purchaser with a new company and no long tail attachment to whatever happened on that property before.
Awesome. Thank you. Is there any stuff that jumps out that I didn't ask that I should have? Because I know you've been doing this all across the globe for the past however long. Is there anything I should have asked you that you're like, well, Joe, this is the obvious question?
No. I think we've covered everything. It's just people want to understand why it's so expensive and it's always going up. I mean, there's so many things in the economy, more people moving to Florida. It's more expensive for the contractors to live in the area where the construction's going on. So the cost of construction goes up. The building codes get stricter, so the cost of construction goes up. The fraud inflates the lawsuits, fraud by the plumbing companies with attorneys, assignment of benefits, frivolous lawsuits, fraud when there's damage to a building and the roof was leaking for 10 years and the roof was replaced, 30 years ago. Obviously that roof needed to be replaced before the hurricane came. The hurricane was just the last straw, right? But so the insurance company is not going to like having to pay for a new roof if the roof was not maintained properly, and you're going to get into a dispute. The insurance company gets sued. They have to pay out all that money. That's what happened. Like I said, Irma was originally going to be $9 billion. They've now paid out almost $15 billion, or expect to pay $15 billion. That $6 billion was inflated because people found, pre-existing damage or want their entire roof replaced or litigation, all these things. What does the insurance company do? Well, they'll probably end up paying, but then they'll say, okay, we're not going to charge 1% in Florida. We're going to charge 1.5 because we know we're going to end up paying $15 billion in the next hurricane, not $9 billion. So it just gets built into the cost. All these things, inflation in the construction costs and the inflation in the losses. And that's what's driving all of these increases in insurance. And that we have to explain this every day to every client on renewal and new clients and people. A lot of people don't believe it until they hear it from 2 or 3 people. They hear the same story and then they understand that there's really no way around it. But just have a good building, good maintenance, take care of it, and deal with a professional insurance agency like us, and you'll be in good shape.
Awesome. Hey, what's the best way for people to get a hold of you?
Moure insurance.com. More with a U. That's our website. All of our information is there, and you can link to through Joe or any of our other partners, and we'll get back to you right away.
Awesome. Yeah, you'll see on the website, you'll see a link to Lewis's site. All his contact info is there in case you need to get hold of it. Lewis, thank you so much for taking a few minutes to talk to us and get me educated on insurance. I appreciate it.
Thank you, Joe. I really appreciate you going the extra mile. You really make a difference by wanting to go into these details. A lot of people don't want to listen to it. It adds value, and I think it sets you apart. It really is something that leads to success for both of us and for the industry. The more technical we are and the more educated we are, it's always better.
Yeah, well, if I can save clients money, that means they can buy another building. So then it's a win-win for everybody.
Exactly. Very good.
Awesome. Thank you so much. All right. Have a great one. Enjoy your weekend.
Take care. You too. Bye-bye. Stay safe.
Bye.